I watched my parents lose their jobs in the real estate industry back in the savings and loan crisis. And then I saw 9/11 happen. I saw 2008, 2009. So I was seeing these things in my own life. So when I heard the author speak several years ago, like a light bulb off in my head.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How are we doing?
We're good. Just got off a call. We are finalizing a contract for a property selling. So,
nice.
That's a nice thing.
Are we happy with the contract or are we unhappy with the contract?
We're never happy with the contract. We always want more. No, we're good. It's still water property that, we're getting ready to sell. So we're good. I mean, it's a pretty generic, straightforward, not many changes. So it should be, it was an easy one, quick, 15-minute call is never a bad one.
I hear you. It's always interesting dealing with the different sellers and seeing what people care about. It's definitely, it's interesting. I just had, I haven't talked about it yet. I guess it's good as time as any to talk about it, but I'm actually buying a small property for myself down in Florida and just got it under contract. So going to be heading down there the next week or two. But it was really interesting to see the things that they, every seller kind of cares about differently in the contract. Everyone's got their little things. It's kind of fascinating, actually.
That's what I was saying. It's crazy. Some guys stick, they will not give up. And sometimes you scratch your heads like, that's really where you're going to stick. Like there's so many other points that are significantly more important, but it's a funny dynamic what people care about.
Mm-hmm. Yeah. The one thing that kept getting held up for us was in seller default, the transaction costs. They just felt that we would spin anything into a seller default. So we would get our transaction costs back. So attorney, LLC, travel, etc. And then the other thing he said was, I don't want to pay for your high New York cost lawyer fees. And I was like, is it really going to be that much more? We're talking about it, even if it was double, right? You're talking about a couple, few $1,000 difference. It's not like this is a $40 million deal and we're talking about tens, if not hundreds of thousands of dollars. It's a $1 million property. It's not that big of a deal. So it's just funny how different people view it. And he's out of California too, which is really interesting.
Sometimes perspective is crazy as well. Like you said, right? How much more money is the local yokel attorney to ours? It's not. Our attorney could bill at $5,000 an hour to negotiate the contract, which would be a completely ridiculous price. Nobody's charging that. And what are you talking about? A couple $1,000, right? Mm-hmm. It's not. But people get hell bent on pennies sometimes. On on $1 million deal. I saw there was a post the other day I saw where it was like a $28 or $38 million deal, and they were arguing over $50,000. And I'm not saying the $50,000 matters. But if you're buying a $30 million deal and you can't figure out $50,000, you got a major mistake in your deal. It's just $50,000 shouldn't throw those deals off, right? It's just you're buying something you shouldn't be buying. And so it's just it's entertaining to see.
100%. With that being said, let's get into today's episode. Maybe we'll dive more into this. Maybe we won't. But super excited to have him on today. Definitely want to hear more of his story and learn more about him because I did a little bit of research. But truthfully, not a ton. So I'm going to be listening along with you guys and learning more about him. So with that being said, Chris, thank you so much for coming on.
John and Chris, appreciate you having me.
Yeah, absolutely. So kick us off. Tell us a little bit more about you, your background, your experience, and what you're doing.
Yeah. So my wife and I, with our two young boys, 8 and 10, live in Asheville, North Carolina, by way of Virginia. Grew up in Maryland. My wife and I met at Virginia Tech, which is where I bought my first investment property at age 21. So almost exactly half my life ago here. I'm 42 this year. From there, grew my portfolio and managed it myself until we transitioned in 2013 to multifamily, which has been our focus here for the past 7 years. Mm-hmm. Had some bumps along the way. If anybody wants to kind of learn a little bit deeper about my story, they can check out our book on our website, nextlevelincome.com. Just click on the book link and I'll send you a free copy. But long story short, I wanted to be a professional cyclist. So I was in college, I was racing my bike, and things were great. I went from Cat 5 to a Category 1 cyclist, which once you're Cat 1, you can turn pro. But between my freshman and sophomore years, my best friend passed away. I put my head down, raced my bike, didn't really want to be in school, and just wanted to be a professional cyclist. But after about a year of that, I actually won for the second time his memorial race over Labor Day weekend. And I felt empty. I felt hollow. And I thought, is this really the way I want to spend my life? Is this really what I'm meant to do? And I decided it wasn't. So it's a weird place to be in your life when you stop and you think, okay, I've spent, essentially your entire adult life chasing something that you found not to have any value anymore. But what I did want was freedom. I wanted freedom to whether it was race my bike or do what I wanted to do, the freedom to make the most out of my life. And I had started investing. I had a friend that had given me a money magazine that talked about starting a Roth IRA and invest in the stock market. And I was doing that. I was day trading. I was making some months $5,000 a month day trading, but I was stressed out. I was like some nights not sleeping at all. And I thought, all right, like what else is out there? Like what can I do that gives me a little bit more control and a little less volatility? And I started researching real estate, which is how I bought that first property. My wife and I ultimately moved to Asheville from the DC area. And, during another kind of life points when we made the decision to start investing in multifamily. And what I like about it is the control. You can control the appreciation, the passive nature if you're an investor, but also not like Warren Buffett. You're buying businesses that happen to be apartments, you're improving them and you're selling them, and you get all the benefits along the way. So that's been our focus for the past 7 years.
Awesome. What type of multifamily are you doing? Just buying for yourself, syndication, different strategies? What are you focusing on?
Yeah, so we've been syndicating deals since 2016.
Mm-hmm.
So we're on our 8th syndication here currently. So it's always been a value add strategy. It's kind of evolved, Chris, along the way. So when we started out, we were buying properties built in kind of like the mid 70s to mid 80s,
Mm-hmm.
kind of, straight, plain vanilla value add deals. We go in, put $5,000, $10,000 a door into these properties. And we were buying, at cap rates 6%. Today, it's evolved a little bit. Our current acquisition is a 95 build in the Raleigh. It's actually in Cary, North Carolina. The acquisition for that was actually just built a few years ago. So we're focusing more on higher quality assets, still in fast growing markets in the South, which has been our favored markets here over the past several years. That are cash flow positive and still need, say, about $5,000 a door, but a little bit lighter value add than previous.
Interesting. I definitely want to get into that decision in a second because I think it's something we've spoken about because most of our stuff is 60s to 80s built. We have one or two that are newer. So I'm curious to hear that transition. But correct me if I'm wrong. It sounds like you've been syndicating the last 4 years, but you said you've done multifamily for 7. What were you doing for those first 3 years, or did I get my timelines mixed up?
No, you're exactly right. I started as an investor, Chris.
Mm-hmm.
So, I started off investing in these opportunities.
Mm-hmm.
And then my partner and I we actually partnered with the group that we were investing with. And then ultimately, after our first deal, we started doing deals on our own. So kind of grew from there. Kind of did like an apprenticeship, if you will.
Gotcha. Understood. And what have you been doing? Because I'm not sure I'm 100% clear on the story and the time. What have you been doing that allowed you to start passively investing? Like, was it a job? Was it the other real estate? What allowed you to start investing passively and then ultimately start, buying rentals, which takes capital unless you're trying to do these crazy creative strategies?
Yeah, great question. And if you look at our website, nextlevelincome.com, we talk about how to make more money, how to keep more money, and then how to grow your money, how to invest your money and do that. And I had the same dilemma. So here I am, 20 years old. I want to buy this property. I was fortunate with the loan I got. It was less than $3,000 to buy this $90,000 townhouse. But my mom co-signed on the loan with me. And then I thought, okay, how am I going to get money to buy my second property? The next one, I think it was about $10,000 down. But I thought, okay, I want to invest I need some money. I started looking at careers, and it's interesting because the same thought pattern that led me to the medical device industry, which is what I did for 15 years and what I continue to do in a management capacity, is what led me to multifamily, and it was demographics. So I looked at career opportunities that could be six figures, strong, healthy six-figure income, so I can invest 50% of what I was making. That was always my role. Like if I can make 250, 300,000, if I can invest $100,000 a year over a 5, 10, 20-year period, I can do pretty well. So I entered the medical device industry. It took a couple years to move into that space. That brought me to Asheville, North Carolina. But as I mentioned earlier, it was the demographics. I knew that the baby boomers were active and they were going to need surgery. They're going to need orthopedic implants. And I knew it would be a nice, steady industry for at least a decade, if not longer. Multifamily, I found the same thing when I looked at it. I saw the baby boomers retiring, the millennials going out and needing rentals, needing a place to call home. And when I looked through that, I thought, okay, these are the same thought processes that I went through to find my career. It just made a lot of sense for me to move into that space. But that career, Chris, is what allowed me to invest on a consistent basis. And then ultimately, as you and John are familiar with, you have a property for 5, 10, 15 years, the equity goes, you can take that property and leverage that capital into a bigger opportunity. So we've just continued to recycle that capital, if you will, into bigger and more cash flowing deals.
Mm-hmm. So I think it's something we've spoken about before, but I don't think we've spoken about in the last several episodes. So I just want to bring it up again. Those early years, you were just doing it with your own capital on the real estate side, correct? What was that timeline like for you? Like how quickly, how slowly were you able to kind of scale up?
It was too slow, in my opinion. So, my initial strategy, and this is why if people ask me, I say, go find somebody that has done what you want to do and ask them how they did it. So you don't have to take as long as I did. So my strategy was buy enough properties so I could have $10,000 a month coming after expenses. Mm-hmm. And I thought that's great. Like I can be financially independent at that point. So I bought enough properties and I got to work basically paying off the debt on those properties. And I was about 5 years into my 10-year plan and I was working great. But what I realized, now I have an MBA in finance, and I started to look through the numbers and my returns were going down as my equity was going up. So mm-hmm. Think about it. If you put $3,000 down on property and you're making $3,000 a year, that's 100% return, right? Mm-hmm. Well, if now you have $30,000 and you're still making $3,000, that's a percent return. Even if you double that to $6,000, that's a 20% return. But as that equity continues to grow, that return fell lower and lower and lower. And then I was paying tax on that. So I was looking for ways to increase my IRR on my equity and pay less tax as a high income earner. And that's why I started looking at commercial. But I spent from age 21 over 10 years just managing that single family portfolio until I ultimately started. Once I was accredited, I started to sell off that portfolio in 2012, 2013, and it took me about 2 years. Sold the last property in 2015, and now we're 100% commercial. Although we just built a house, and we're going to have a rental as well as an Airbnb property here. So little shift of gears, but it's going to be a good addition to our total portfolio here.
Nice.
And you're in Asheville, right?
Yeah.
It's a beautiful market for that. I'm sure that's going to work out really well. We have a war story in Asheville where we lost a deal on a retrade of a roof when we underwrote the roof to be redone. This is like 2016, maybe even 2015.
Yeah.
And the broker took the easy path out with a guy on a retrade instead of coming back to us. And when we followed up, he told us, and I was like, and that's a market that I've tried to get into for quite some time. It's just been a day late, a dollar short, but I'm sure your rental with that Airbnb is going to be awesome because the upstate area of Carolina is there's just a ton to do. It's just a really cool area. So that's awesome. Complete sidetrack.
Come visit anytime, man. Seriously. We'll go look at some deals.
There you go.
Awesome. So I want to go back to what I said we would come back to of that shift from the 70s, 80s product to, I think you said 1995 product. And I'm sure in or thereabout, let's call it 90s to 2000s, I would think, correct me if I'm wrong. When did you start having that conversation of changing? Why did you start having that conversation? And when did you ultimately kind of pull that trigger?
Yeah, a little over a year ago. So started to look at kind of the way the economy was going. And I've always looked at the real estate cycles, and I have a book here. It's called The Secret Life of Real Estate and Banking here behind me on my bookshelf. I encourage anybody to go out there and get that. It's called The Secret Life of Real Estate and Banking.
Mm-hmm.
And in it, the author talks about the life cycle of the real estate cycle. It's about 19 years. And I talk about in my how I watched my parents lose their jobs in the real estate industry back in the savings and loan crisis. And then I saw 9/11 happen. I saw 2008, 2009. So I was seeing these things in my own life. So when I heard the author speak several years ago, like a light bulb off in my head. So where we are in the current cycle, in my opinion, is we're kind of at the midpoint. And at that stage in the cycle, you're going to see cap rate compression. You're going to see, land start to dry up. It's going to be harder to develop. We've seen a lot of development in the urban cores. So at this point, I want to transition to higher quality assets, higher cash flow, maybe minimize the risk as we were going into 2020, which I considered to be kind of a risky year as far as the economy is concerned. I certainly don't have a crystal ball. Otherwise, I would have bet heavily on this whole COVID crisis thing that happened, and I would have just set sail into the sunset. But I did have some concerns about where the economy was, and that was a big part about the transition, kind of up the quality spectrum, if you will, with respect to the class of assets that we were buying. So kind of going from C plus B minus to B A minus assets.
So you said, I'm a little, maybe I don't understand. You said, looking for higher quality assets and larger cash flow. And typically you don't hear those two things go hand in hand. How do you feel you're able to get better quality assets and higher cash flow?
Yeah. So if you think about, if you're performing a pretty heavy value add or a heavy lift with a value add property, you're going to have to drive vacancy higher as you turn those, as you turn those units, right? If you have a stabilized asset that is 99 or 100% stable, and you don't have to turn as many of those units to execute your strategy, and you're going to be able to keep that occupancy higher. If you're starting out at a 6 or 7%, cash flow for investors, on the capital, then you're not going to have to drop that. Typically, what we were seeing on the heavier value add deals is that we were seeing a bigger chunk of the appreciation come on the back end after those renovations have been done. So I agree. It depends, Chris. If you're buying a cap rate property, sometimes you can expect more cash flow. I think it depends a little bit as well on what strategy you're implementing there. So for us, again, more stabilized assets. If you look at now, the average occupancy of a C plus or B minus asset is less than 90%. Whereas if you go up the spectrum, you're seeing mid 90s when it comes to these B plus A minus assets. So you get higher cash flow, you have higher occupancy.
Gotcha. That's interesting. I know one thing that we've spoken about and other people have spoken, it's not, an entirely new conversation, is that as competition for the value add BC space has continued to increase, cap rates have continued to come lower and lower, almost in line with the higher quality assets. And the argument we've had back and forth is, why are we going to pay the same cap rate almost for a worse quality asset when we can buy something nicer? Obviously, the answer is there's probably less forced appreciation that you can do once you kind of go into that higher space. But then there's also the argument of, if anything ever does revert and change, that higher quality asset will probably hold its value and cap rate a little bit better. How are you looking at those two things? Did you just think the risk of the lower quality just became asymmetrical to the reward? Like, what was your thought process there?
Yeah, you're spot on. That's exactly right. So, if you're looking at buying at a 7 cap for a 78 built property versus, now today, sometimes sub 6 cap, for a similar property because of that competition that you mentioned, and you can buy a property that's built 20 years later at a similar cap rate. The question is, okay, do you have the ability to make the changes? What we have to remember is, if you're looking at an asset where you and I may want to live, we probably want things like, high speed internet. Maybe we're going to pay a little bit more for a washer and dryer in the unit. There's going to be a little bit more rent flexibility. So you may be able to go from $1,000 a month to $1,200 a month if you're in an area where the average income is, say, $90,000. Whereas if you're charging $700 a month to $900 a month, that's a bigger percentage jump, with respect to that. But that same $200 is going to provide the same amount of value at the same cap rate. It's actually going to provide higher value at a lower cap rate. So there's a bigger lever, if you will. So it's always important to remember, if you're an investor and you're listening and you're thinking, well, I would never buy something with a five cap. The difference between a 5 cap and a 7 cap on $1 of income, the multiplier is 20 with a 5 cap. Was with a 6 or 7 cap, it's more like 15 or 16. So there's a bigger percentage change there as well. So you have, like you said, Chris, we like the stability of these higher quality assets, in a downturn, but also there are different opportunities for forced appreciation at different areas of the spectrum as well.
Mm-hmm. What do you guys? Because I know as you go up an asset class, new construction is probably something that makes more sense when you're looking at. So, because like replacement costs and can you speak to when you're getting involved in the nicer stuff, the 95, 2005 built product, what do you guys like to see a delta between either construction cost, replacement cost, or like a rent level to say, yeah, we have a newer product, but we're still below there? Because obviously with 20 million plus people out of work and so much uncertainty in the market, where do you guys find yourself on that spectrum, or what things do you look for? Because I think that's always interesting. And obviously we don't have a crystal ball here, but right. That's always the interesting comparison when you start going up an asset class in my eyes.
Yeah. So we're typically, John, looking at 10, 20% below where the new products come for rents. So replacement cost is one thing. Obviously you don't want to be paying, a high multiple compared to replacement cost. Although if you're paying around the same price for replacement costs, you have a cash flow asset from day one. So you're not incurring that risk for that lease up into a soft market. So there's that to consider as well. However, if we just bought a property earlier this year and the seller is building a new property right across the street, and investors are like, well, why are you guys doing this? It's like, you're going to have this competition. Well, our rents are going to be about $200 below what they're going to be. So we're going to have right there in front of us an A/B test. So we're going to be able to see what the appetite is for those higher rents and what amenities that they're going to have. And we're going to have somebody that's going to be advertising and pulling in residents. So there's that aspect. The other component that you have to analyze when you do this is delivery. So if you're in a market where there's been a ton of units delivered, you may have a situation if you're coming and you're buying a property right next to it. You may have a situation if you're trying to build into that market where it's already, deliveries are high. The flip side of the spectrum is you look at someplace like Charlotte that needs like 30,000 units a year just to keep up with pace. I mean, it's how are you going to, I'm sorry, maybe it was 3,000 units a year. I may be multiplying by 10, but still 3,000 units a year, that's like 20 new communities, 15 new communities a year that need to be delivered. So in that market in Charlotte, we're confident that, the demand is going to persist in that area. It's in a really nice suburban area. So people are moving out of the city during, all the stuff that's been happening during the pandemic. So things we look at are how far below rents are we for new product? What have the deliveries been? And do we have the ability to add amenities that are not there in the new product that's coming out?
Awesome. Then to that point also, because I think it's interesting, once you start getting into that space, the higher income people, the higher income earners, where do you guys gauge the stress test, especially what just happened, right? I saw an article yesterday that housing stock is at a 40-year low where people were not buying houses or renting houses. Where do you guys weight that? Because I think that's a super compelling part to this class A or B plus space as well, where now these tenants can afford to buy houses in the suburbs of Charlotte or something like that. So now how does that factor into a stress test to say, okay, well, these residents may not want to live in an apartment community, or what's the amenity that attracts them, right? Because I had this conversation the other day. If I was building a product, would I put a gym in my new building or would I put an Amazon hub in my new building? Right? I'd probably go with the Amazon hub because gyms are great, but they don't get as much use as they're just a nice amenity to have that doesn't get used. But everyone orders from Amazon. So I love to hear someone that's taken the step up from B, C value add to a class A, B, whatever value add. What's the stress test for like housing look like now?
Yeah, so that is the number one area where we lose our residents is to buying a new house. So you're spot on there, John. So we're going to look at a couple different things. So we're going to look at the median or average income in the area, and we're going to say, okay, where do rents fall within that? Because if you say, okay, 25-30% of your income you can apply to rent, we're going to use that as kind of a top end for where rents are going to top out. And then you're also going to look at affordability gap. So you're going to say, well, if it costs $300,000 to buy a house and somebody can go and they can have a mortgage for about the same as renting, you're going to have more competition in an area like the Research Triangle of Raleigh. The property that we just bought, I mean, homes are $500,000 to $1.5 million in that same area. So if you want to live in that area, chances are you're going to pay twice for a mortgage what you are for rent. So you're not really competing with home buyers in that space, even though that is where we're going to lose. People are going to move, out if they're looking for more space. When it comes to the amenities, we love the Amazon hub. So we are starting to use technology. So residents can walk in, they can get a single use code. Everything's tracked by a camera. So if you go in, you steal Chris's package, then we have you walking in someone else's code with your face on camera if you're going to do that. So in these communities, it's easy to track that. It's no different than by leaving it on your front. It's probably safer than leaving it on your front door, especially if you don't have like a ring cam out front like we do. And then also like high-speed internet. So residents are valuing home offices. They're valuing high-speed internet because they're working out of the house more. Those are things that we're able to get a premium on. Premium when it comes to rent, but we're actually charging less than local service providers. So when you're buying a 5-cap property and you can charge another $100 a month for internet, they're paying $120 for Charter, Spectrum, whoever it is locally. You can do really well with value. I mean, you're looking at over $1 million in value created in these properties just with internet, which is very easy to implement.
Yep,
and we've done it multiple times.
We just did that at our property in North Carolina in Wilmington, and our management company was telling us about it, and they brought it up to us, and I was like, this is insane. Like, you could literally provide internet to the community for cheaper than the providers. And when you value that income, that's real, attainable, valued income. We were backing into the numbers, and I was like a pig in shit. I'm not going to lie, because I was like, holy shit. I was like, I'm rolling this out.
It's like magic.
Yeah. Roll it out, because even the C and B class stuff, right? They use internet too. Now it's a little different, so you got to be careful. But when I was looking at it, I was like, what's wrong here? Because this is one of those that almost seems too good to be true, because your average cable package from whatever the local provider is, and you can provide it for the tenants, and no one watches TV anymore. I mean, it's an astronomical savings. You're going to save your tenant, and it's straight to the bottom line. I mean, it's
oh yeah.
So we did it. We rolled it out on our 99 unit in Wilmington, and I was like, oh my god, like
it's awesome.
That alone puts $2 million of value on the building.
Yeah,
so
it's so sweet. Yeah, and then your question with the gym, I think it goes both ways. I mean, so people are using home gyms. There's a property that I visit that's a condo. It's a condo hotel. So it's a hotel in one part, it's condos above, and they have a great gym. And I'll go work out when I'm traveling there. I'll stay there specifically for the gym. And there's like 2 people when I work out there. So I would argue if you're concerned about sanitation, you're probably safer going to the gym on your property where you're interacting with the same individuals anyway. If you're going into any common space, versus going to like a Gold's Gym. And no offense to Gold's Gym. But so, would you put a gym in before like an Amazon hub, from a numbers perspective? I don't know if that necessarily makes sense, but certainly it is nice to have, good sized gym for residents that, either can't go to the gym or want to stay at their.
I agree 100%. That's what we have this conversation. Yeah. And I was saying, Gym just opened up by us not too long ago, and I'm not. Listen, I'm a short and fat, right? Obviously, I'm not a gym goer, but I do.
I can't
I
tell on
do like.
camera, John. You look great.
We do. I work out. I'll go for a run. I have a Peloton. I'll ride that. Like that's
Yeah.
fine, right? And I'll do what I have to do. But I was just talking to my wife the other day, and I was like, I would have no intentions of going back to a gym right now. Not that I'm like, listen, I had an MRI yesterday. I walked into the doctor without a mask, and the nurse, you would have thought I was going in there with a handgun, right? She was like, "What are you doing? Like, get out of here!" Right? She went crazy. It was in my car. I forgot it, but like I would have no intention right now of going into a Gold's Gym or it just wouldn't. I wouldn't be the first one to do that, and it's just because, like you said, I'd rather go. I lived in a beautiful Class A building before I moved into my house, and that gym, there was 5 people there, right? You never ran into it. And
Yeah.
it was and you didn't have to worry about someone cleaning it or if it was getting cleaned or not. If you wanted to, you did it yourself, right? So
Yeah.
I agree 100%. Now you may weigh it differently with, if you were building something, but it's interesting to see because I agree. If you, as far as sanity and cleanliness, and if you live in a complex, it's probably the same people, right? But
Yeah.
going to a gym is a little bit worse. I agree. It's definitely still an amenity I think is needed. But if you had the choice, that's where I was going with it. But no, I think everything you touched on just makes, a ton of sense and something I've been saying for a while. Why risk the headaches of the C and D and B class space if you can get involved with something that's a little bit cleaner, safer, nicer, and is sexy if it makes sense.
Yeah. It all comes down to the numbers, and that's what I always look at first and foremost.
100%.
So yeah, but all those things, I mean, we've weaved in and out of a lot of different things. So I think the answer is you can make any of the asset classes work. It just depends on what your choices are and your sweet spot is.
100%.
How did you view like the underwriting side going to the upper space? Because I think one of the big differences that we see is your vacancy allowance, some of your conservative numbers, your stress tests where you don't have to be as conservative. You don't have to be as worried because there's inherently less risk in there. But I know when we look at nicer properties, we just get so antsy because the numbers just seem way too, I don't want to say crazy, but so much stricter and so much less room for error, it feels like. How are you just either mentally or, whatever, how did you tackle that kind of problem?
Yes, it's a little different. I think for anyone that's listening that may be considering, going into the space as an active investor, you need to make sure that you have good relationships with your management companies there on the ground because they're going to have the market knowledge. And you need to make sure that, let's say you're buying a B plus asset and you're moving it up the spectrum to an A quality asset, you're adding amenities. You want to be working with a management company that specializes in where you're going, not where you are. Make sense? First and foremost, they're going to be able to give you the numbers and that. I have a blog post that's coming out. It should be out when the show airs by one of my partners, Brandon. He talks about due diligence in the time of COVID. And if you're an investor and you listen to like our webinars or you're talking to me on the phone, we've baked in higher vacancy rates because what we've seen during COVID is people are less likely to move around. Now that's freeing up a little bit as we enter the back end of the year here, the last quarter of the year. But we've definitely become more conservative with respect to that. I think you have to look at, like we were talking about before, what are the collection rates? So if you have a C plus asset, you may write in, higher, you may have some higher write-offs for collections, over the next year. And I think the other thing, if you're looking at an operator and you're looking at an offering that's out there and they're saying, hey, we're going to raise rents 5 or 10% in the next year, I would ask them really hard how they're achieving those rent increases, because what we're doing is we're underwriting essentially 0% rent increases over the next year on our deals. So we're increasing vacancy, we're decreasing rent increase expectations. That's allowing us to go to sellers, also ask for slightly lower pricing than we were seeing before. Obviously, we have some shift in the interest rates since the beginning of the year, so that's going to offset some of these differences. But again, first and foremost, work with your local boots on the ground. 2, be more conservative and get all ends of the spectrum. And then three, also make sure that you're comfortable with, the expectations that you have here as we go into 2021.
Gotcha. Interesting. Um, what was the conversation like with investors too? Because I think, when you build up an investor database in syndication, you have certain target criteria. They have certain expectations for returns, risk, etc. Those things are probably changing slightly for better or for worse across the board. What was that conversation like with those investors? Did you have a lot of them transition with you? Did you have a lot of them fall off? Did you have to go out and get, a new set of investors? What was that experience like for you?
Yeah, whenever you shift a little bit, you have to be consistent. So I think the value add discussion that I talk about in my book has been consistent all along. I think, I didn't dive as deep into the real estate cycles and talking about that. So there is an education, that comes along with that. I think as you go up the spectrum, it's easier for investors to understand, especially if you're dealing with an investor that looks at a property and says, "Oh, I would live in that property." There's some sort of visceral appeal to that versus an investor that looks at a property and says, "Well, I can understand how people need to live in that property," and there's a demand for that. I think it's a little more conceptual, as you move down the spectrum, at least for our investors, than going up the spectrum and doing that. So if you're saying, "Hey, Mr. and Mrs. Investor, you can get a similar cash on cash return and you can get a similar total return that we were looking at, 1 or 2 years ago in a property that's 20 years older," that's a pretty easy discussion to have. I think, we've already talked about this, with the cap rates. It's like, well, I don't understand. How can you buy a lower cap rate product and still, end up, with good cash on cash returns? So explaining kind of how those, knobs and levers work within the assumptions and within the operations, it takes a little bit more explaining with respect to that. But that's part of the education process, and what I really enjoy most about what we do is educating and talking to investors one-on-one on a daily basis.
Mm-hmm.
Quick question, because I know when we talk cap rates and cash on cash, is inevitably debt impacts that decision, right? So, if you buy a 6 cap cash and a 4 cap cash, you don't get a higher cash flow on a 4 cap, right? You get a higher cash flow on a 6 cap with no debt involved.
Right.
What are you guys on the deals? How does debt implicate any decisions, or does it not? It's just, yes, the reason why cap rates compress is because debt is just falling off the cliff, and it's not free money, but it's as close to free money as you're going to get today. But where does debt stack up in your capital stack, right? Like, how does that go about the decisions? Because that's going to make a major decision, with, bridge debt, all different types of loans that are out there. But how do you guys use that when you're underwriting, as a stress test level to say, hey, worst case scenario, check this out, right? Where does that fall into that, into that discussion?
Yeah, so it's huge, right, John? Like, you guys know this. So first and foremost, we're using super high quality debt, Fannie Mae, Freddie Mac, and the rates we're looking at now today, going into Q4 are in a lot of times sub 3%, which is fantastic with, sometimes 5-7 years of IO. So that interest only is going to help the cash flow well. Whereas if you have a heavier value add deal, you may not get quite as high quality debt. So, you may be facing, some compression returns there. The other thing to remember is if you're doing a lighter value add deal, you're not going to have quite the capital expense budget. So, if you buy a $10 million property and it's got a pretty heavy value add component, you need to raise $5 million. The returns are going to look different than if you buy a $20 million property and you have to raise $7 million, right? So there's that component as well, because you have less capital that's coming in that you have to pay out returns. So there's that piece. The other piece is, okay, what is our break even? So we're always looking at, okay, the property we have out to investors right now, break even sub 60%. We can pay all our expenses at sub 60% occupancy. So that's huge. One of the ways that we achieve that is we have a dual tier investor structure. We have Class A investors and Class B investors. The A investors act almost like mezzanine debt. So they're coming in, they're getting a fixed return, where the B investors preferred return plus upside on the back end. So we had an appetite for investors that were coming in and saying, hey, Chris, it'd be nicer to get a little bit higher return, but I want less risk. I want more of a higher cash on cash return, so we can put them first in the capital stack. Still a lot of upside for the Class B investors. They're still getting a very stable asset, and we're not having to leverage the property with outside or mezzanine debt. We have control over it as well. So what that's allowed us to do is maintain or increase returns for B investors, lower the risk on the asset, and also provide investors with another type of investment opportunity that suits their needs.
What just besides the obviously it's a preferred equity piece, right? Just like mezzanine debt. Is it just a regular operating agreement, the security, or what's the mechanism if it goes south, right? Let's talk about the downside. Because as a Class B investor and a Class A, or the two tiers, obviously the risk in Class B, people like the upside, and the risk in Class A is it's consistent, no headache. Worst case scenario, it's going sideways. Let's just say there's 20 investors in the deal and 5 of them are Class A. How do those 5 people now step in if it goes that way? Like, what's the protection there? Because it's we've done the same strategy and it works, but hearing it from somebody else.
Yeah. So if you look at it, we talk about the waterfall or the capital stack. So the lender is going to get paid first. So that bank debt's going to get paid first. Then the Class A investors and the B investors. So if you're a Class B investor in a deal like yours or like ours, a good question to ask is, okay, at what point are the A investors, going to break even? So, and again, if you're looking at a deal that's breaking even at 55%, it may break even at 65 or 70%. That's still a really stable, solid, in my opinion, safe deal, even if you're a B investor. If you're still getting paid out at 30% vacancy, that's pretty solid. I don't know if it's quite as high as safety as a corporate bond or I'm sorry, as a government bond, but I like my chances with a real asset and paying residents versus even the United States government today.
I hear you 100%, and it makes a ton of sense. And right, that was that's the question people have to ask. If you see yourself looking at deals or structuring deals, you just want to know what the levels have to fall to where it becomes, you want to know where you're at. Because I know Chris talks about it all the time. There's so many people that flip right to the back page and they see the return and they don't even understand the level of magnitude. I saw a deal the other day where they were bringing in mezz debt, not as like a Class A and a Class B. It was an outside company, and I looked at the deal and I was like, this thing's levered at like 87%. Yeah, this one's not going to work, right? That mezz piece is coming in with the fingers crossed and hoping it goes sideways. So just obviously understanding that, knowing with those levers and what that risk looks like. And that's the purpose. And, anyone listening, if you find yourself in that situation, either structuring and or investing, make sure you understand that, because that's huge. And most people don't understand the capital stack. So I appreciate you breaking that down.
Yeah. It's a great question. Again, just to recap, if you're an investor, ask what the leverage is, loan to value, ask what the break-even numbers are for the lender, for the property, also for the investors if it's split, and make sure you're comfortable with those numbers. Because like you said, John, if you have an 87% LTV, that's pretty damn high.
It was crazy. The deal was sent to me, and I looked at it, and they actually asked if they had the mezz piece in place, and they said they needed a sponsor to help co-sign the loan. I was like, I wouldn't do this if they gave me the loan. And it was a ridiculous deal where they said the IRR was like 16, but the cash on cash was 28. I'm like, you guys got mistakes everywhere. Like, there's just mistakes all over this
or
thing.
They're just losing money on sale.
I was like, what's going on here?
Yeah.
It was in a C-class area, like 100 a door, in an area that we've looked in and just 6-7 years ago. I was like, nah, this is an automatic pass. So
28% cash on cash. That is if you're an investor listening, red flag, definitely. At least a yellow flag. You got to take a hard look at that one.
That's what I said. I was scrolling through the capital stack and I saw the first position loan, and I said, "Ooh, this one's tough, right? Like this one, there's gonna be some people crying at the end of this." And I just advised, hey, listen, I'm not, it's a market that I know extremely well. It wasn't it wasn't like a 7,000 unit complex. It was a decent sized deal. Maybe I think it was in the $24 million range. And I was just like,
Yeah.
this one's got some problems because there's just nobody knows what's going on. So it's fun to see the stuff that's out there. And then you realize when you stack that up against stuff that makes sense, there's still deals transacting, right? Velocity's down and volume down, but there are deals out there to be had. You just got to find the ones that you feel comfortable diving into.
Absolutely. And that's the most important thing. Make sure you understand what you're getting into as an investor, guys.
Yeah, I think that's really important because of something I was talking about with somebody else, and it comes back to the break-even point of if you've got a certain cash on cash and you can have a higher cash on cash, but if your break-even is 80%, the amount it's going to be affected is going to be significantly quicker than something that has a 7% with a 60% break-even. So that relationship really needs to be understood as people are looking about deals, and how does it affect it? Because if there's a pref equity piece within, an A-class investor, like in your deal, Chris, that B-class investor is going to be affected quicker than if it was all just common equity. So understanding that relationship is highly important going into it. And that's where you're talking about the 60% break even versus 70 or 75 for that class B. There's nothing wrong with that by any means. It's just people need to understand how that relationship works, and that the deal that you are presenting to investors, that deal is going to change if you have that A and that B, and what are the terms for the A and the B, and how does that relate, and how much equity are you raising for the A, how much debt. And like you said, there's a lot of levers to pull. And I am very fearful every time somebody invests, because I know 75% of the time, like John alluded to, people just flip to the back of the book and want to know what it is. And they don't look at any sensitivity analysis you give them. They don't pay attention to it. They don't do it themselves. So I think it's very important that as people are looking as passive investors to really, you don't have to understand it to the same level as us, but just look at the numbers and say, okay, if I take away 10% of the income, what happens to my return? How does that get affected? If you can't do that, either the book isn't put together well enough that you don't have the right information, or you need to really trust the person, or you need to start doing a little bit more homework to understand how it works, because that shit happens and you need to understand what's going to happen to your money if and when it does happen.
Absolutely. Great point.
Yeah. I think that's a great place to wrap up. We're coming up on time. I think we touched on a ton of great stuff here. So Chris, can't thank you enough. If people want to learn more about you, get in touch with you, follow along, get a hold of your book, where can they do all that stuff?
Yeah, check us out at Next Level Income, nextlevelincome.com. You can get a free book by clicking on the book link, get a PDF. I'll even send you a copy. If you're listening and you put your address in, you can get our podcast or blog, all the information there as well. And if you have a specific question for me, just email me at chris@nextlevelincome.com.
Beautiful. Guys, definitely go check it out. Definitely going to be a ton of great info for you there. And thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are subscribed, please send it to someone who you think would get a tremendous amount of value from this episode with Chris. Chris, once again, thank you for coming on. This was fantastic.
John, Chris, thank you guys for having me. Best of luck. Stay warm out there and come visit Nashville.